Hi Scouts, this is Sean. In this video, I'm going to be covering requirement number 5 of the Personal Management Merit Badge. This is going to be a long video, so please have your workbook out and take some notes while watching this video. So let's get started. So before I start requirement number 5, I'm going to be teaching you how to read a stock ticker. So while this isn't necessarily one of the requirements, it's something that you should know, and it's something that's good to know, especially since this is a personal finance basically like merit badge. So here's a stock ticker, and for the example, I'm using Apple. So can you see a lot of things? I'm gonna teach you what each of these things mean. So like when you look up a stock ticker, this is kind of what it's gonna look like. So I'm gonna teach you what each thing means. So the previous close is the last recorded price after a day's close. So the stock market is open from 9:30 to 4 p.m. Eastern time, and it's in New York. So the previous close is the price that a stock closed at after the stock market closed. Now the open is the price that the stock opens at. It's pretty self-explanatory. Now the range is like how much the price has been over the last certain time period. So there's a day range, so the price of Apple stock has been from a certain range to a certain range, right? And then the 52-week range is the range of a stock within the past year, basically. EPS is earnings per share. And basically, this kind of helps you indicate how profitable a company is. And you can calculate earnings per share by taking the net income or how much a company makes divided by the shares outstanding. Typically, you're looking for the EPS to be increasing over time, which indicates that a company is well run and is becoming more and more profitable, which is good. Next, the PE ratio. So this is something you're probably going to see when you're beginning or learning to invest. So the PE ratio is a price to earnings ratio. And basically, it tells you how overvalued or undervalued a stock is. So another way to think of the PE ratio is how many years it'll take for your money to double. So if a stock has a PE ratio of say 20, so it will take 20 years for your money in the company to double, basically. And this can be calculated by taking the price of the stock divided by the earnings per share or EPS. Next, we're going to talk about the volume. So the volume is the number of shares traded during the period of time. And this is usually during the day. So as you can see on the stock ticker chart for Apple, there's around about 32 million shares traded during this one trading day. Next is beta. So beta tells you the volatility of a stock compared to the S&P 500, which is usually considered like the broad stock market. It's usually used as like a benchmark. So a beta over 1 means that the stock is more volatile than the S&P 500, and a beta under 1 means the stock is less volatile than the S&P 500. So for Apple, it's a little bit more volatile than the S&P 500, but it's not that volatile. Next is a dividend yield. So if you don't know what a dividend is, a dividend is basically money, or it's a profits that a company makes, and they give it to the shareholders as a kind of a reward for investing and owning stock in that company. You can calculate the dividend yield by taking how much a company pays, so the annual dividend every year divided by the price of a stock. And as you can see, as in this example, Apple has a dividend yield around 1.5%. So here's a chart of what $1,000 invested about 10 years ago would get you. So this is a couple years old, but there's many companies I'm sure you're familiar with. There's Netflix, there's Amazon, there's Apple, there's McDonald's. There's a wide range of companies. So as we talk about investing, think about like what companies or products you use daily in your life, and see where they're publicly traded, or the companies that you deal with on a daily basis. They're on the stock market, and you might want to think about investing in them because you're using their product, and if there's something that you really use and you enjoy using, then you should really think about investing in that companies. So here's a video by this famous investor named Bill Ackman. It's basically he teaches you personal finance in under an hour. I'm not making you watch the whole video. I only want you to watch a certain part of the video. So the timestamp is right there. It's 21:35, 35:44, and in that section he basically talks about investing. You're free to watch the whole video if you want. If you're interested, I highly recommend it, but you don't have to. So please pause this video, and then there should be like a notification on the upper right hand corner that directs you to the video. You can also go down to the description down below, and you can click on the link to watch the video. So please watch this video. So pause this video, watch the Bill Ackman video, and then come back to this video. All right, and then also here's some great investment books to read if you're ever starting out. So there's The Intelligent Investor. You might have heard of it. It's a book that Warren Buffett's really talked about that really got him into investing. There's also One Up on Wall Street. This is one of my favorite investment books. It's by this guy named Peter Lynch, and he was a famous investor. He ran a investment fund for about 13 years, and he beat the stock market every year, which is really incredible. And then there's also Common Stocks, Uncommon Profits, another book recommended by Warren Buffett. Out of the three, I recommend One Up on Wall Street because The Intelligent Investor and Common Stocks and Uncommon Profits, those were written during the 1950s, so the language might be a little bit dry. But if you're interested in reading it, go ahead, try it, you never know. Alright, so now we're going to start requirement number 5. Basically, we're going to be talking about common stocks, mutual funds, life insurance, CDs or certificate deposits, savings accounts, and US savings bonds. So common stocks, so we kind of talked about it earlier in requirement number 4, but I'm going to explain it again. So basically, common stocks, they're used to help grow your money over a long-term period of time. So one of the advantages of common stocks is that there's a potential for growth, so your money can grow dramatically over time. Now, the disadvantage of common stocks is that you can lose the money you put in a stock because stocks are volatile and companies can go bankrupt. So if you own stock in a company that goes bankrupt, you're basically wiped out. You've lost all your money. So you gotta keep that in mind. Another thing is that stocks, they pay dividends. So we're talking about dividends, basically the company pays out a portion of the profits they make to shareholders. That's kind of a reward for owning and investing in that company. So there's certain companies that really pay out a lot of dividends. So if let's say you're about to go to retirement, or you just want kind of a steady income stream, then you can invest in these dividend stocks, and then you can actually make some money out of it, have a passive income. Now, a disadvantage of stocks is that there's no guaranteed profit, so you're not guaranteed to make money in the stock market. There's some people, they don't do well in stocks, but there's a solution to this, and we'll talk about this in a little bit later. Another advantage of stocks is there's a lot of choices. There's a lot of different companies on the stock market that you can invest in. With this, there comes a risk, right? You have to kind of be careful and discern, what companies you're investing in. You gotta make sure they invest in companies that are growing and are profitable and that kind of thing. Now, disadvantage. So this used to be a disadvantage, is that there used to be so when you bought stocks, you would have to pay a transaction fee or a commission. However, as of this video, most of the major brokerages have gotten rid of transaction fees, so this isn't really something to worry about anymore. But in the past, you had to worry about transaction fees because some companies, they would charge like $10 for every transaction you made when buying or selling stocks. And then, like I said, the advantages of common stocks is that it benefits those who choose well. So if you're a good stock picker, like for example, Warren Buffett is a great example. He's been a fantastic stock picker, and as a result, he and his shareholders have been dramatically, really rewarded over time. And if you ever looked up the Berkshire Hathaway, the stock chart, if you look at the stock chart over like maybe 10 or 30 years, the stock has just gone up. Now, another disadvantage is that you have to set up a brokerage account. So for most of you, you probably can't get one until you're 18. However, if your parents are willing to, you can also set up what's called a custodial account. And this is what your parents are in charge of it, but it's also under your name. And then once you turn 18 or 21, depends on what state you're in, then you can assume control of the account, and then it's now your money. So basically, stocks are used for the long-term investments to grow your money. Now, mutual funds, they kind of take what the benefits of stocks, but they also, it's also for the masses. So let's say, you don't want to, research stocks, right? You don't want to research what companies invest in. Well, mutual funds, they offer you a great alternative, because then you can basically, what mutual funds are is that a bunch of investors, they pull money together and they hire a manager, someone who manages this fund, and the manager basically picks stocks and he tries to they usually try to beat the stock market. They can also try to mimic the stock market, get the same return as the stock market. Now, the advantages of the mutual funds is that there's less risk. Since typically in mutual funds, the managers, they try to spread out their risk by investing in many different companies, so they're practicing diversification, as we talked about in requirement number 4. But however, the disadvantage of this is that you have to typically pay the manager, and this is usually taken out of your returns every year. So they charge something called expense ratio, and that's basically the manager expenses, or how you pay the manager for managing a mutual fund. Another advantage is that, like I said, there's less research, so you don't really have to research that much. You just have to find someone that you're comfortable with, someone who's a proven track record of doing well, of managing your mutual fund. But also there's a less potential gain, which is a disadvantage, right? Because then with individual stocks or common stocks, you have a greater chance of making your stocks going up much more than a mutual fund. There's also a lower cost of entry. So I know for many mutual funds, these days you can invest as little as $1. They don't really charge that much minimum fees anymore. So that's great because if you don't have a lot of money, and you want to invest, a mutual fund is a great way to do that because it doesn't require that much money up front. A disadvantage is that there's less control over choices because so the thing with individual stocks, right, is that you can choose what companies you invest in. But with a mutual fund, you can't really choose that. You sort of can choose that, but it's up to the manager usually. However, if you don't like what your manager is investing in, then you can always switch to a different mutual fund and invest in a mutual fund where you agree with the manager's investment philosophy. Next, we're going to talk about life insurance, and we kind of talked about this earlier in requirement number 6, I believe. So the advantages of life insurance is that it's used to provide a benefit in the event of a death. So right, if you're worried about your parent or your offspring or your children, your family not being well off after you die, you can use this kind of as like a just in case policy. The disadvantage of it is that it's not really an investment. Now, another advantage of life insurance is that it has a fixed value. So over time, it's usually like 1 million or 500,000, depends on your insurance policy. However, a disadvantage of life insurance is that they have really kind of complex policies, and it's kind of difficult to understand it. And they can also have poor returns over time. It depends. Another advantage is that it's heavily regulated by the government. So the government really, they have like insurance commissions that kind of look over this thing, make sure that people aren't being scammed. But disadvantage is that you have to continue paying the premium, which we talked about earlier in requirement number 6, to keep your benefits. So if you stop paying your premiums or the money that the insurance company uses, they had to pay you out for your life insurance, if you stop paying that, then you won't get the life insurance. So you have to keep paying it until up to your death or whatever event happens. Next, we're going to talk about certificate deposit, or otherwise known as a CD. So a certificate deposit is basically kind of a savings account and a bond, and we'll talk about what a bond is in a couple minutes. So basically, a certificate deposit, the advantages are they're very safe. So like savings accounts, they're insured by the FDIC. So if if they go bankrupt or something happens to it, your money is safe since it's insured by the federal government. They're also very easy to buy. You can buy these. You can go to your local bank. They usually offer CDs. You can also buy it at a brokerage firm. They also have a very predictable rate of return. Typically, it depends on the interest rate. It's usually like a couple of percent, 1 to 2%. And they usually have a better return than savings account. Most savings accounts, if you go to the bank, they don't offer you that much interest rate. The interest rate usually is like 0.01%. It's very low. And the great thing about certificate deposits that they offer is that they usually offer better interest rate, typically 1 to 2%, but it depends on the time frame. Now, like I said, disadvantage is that they require a certain amount of time. So you have to put away your money for however long the CD is. It can be 1 month, 3 months, a year, 5 years, 10 years, 30 years. It depends. But the problem is that if you try to, like, let's say you want your money earlier, typically you might have to pay like a penalty. It depends on your CD. And then you might lose some of like the interest and the kind of compound interest you might have gained. They also have a low rate of return compared to stocks. So stocks, like I said earlier, they gain on average about 10% a year. CDs are much slower. They're a couple percent. And you can also lose money due to inflation. And if you don't know what inflation is basically the idea that your money becomes worth less over time because things increase, right? So if you ever seen like in the 1950s, they say like, oh, hamburger was like 50 cents, right? But now if you go to like McDonald's, it's like a couple dollars. That's inflation. So prices have increased over time. And typically the inflation rate in the US is around 2%, and most interest rates in the US are about 1 to 2%. So that's bad. So if the inflation rate is greater than the interest rate, that means that you're losing money because your money is becoming worth less over time. Next, we're going to talk about savings account, and I think we also talked about this earlier, but advantages of savings account is that it pays interest, right? It's very easy to open and access. You can easily get your money. You just have to go to the bank and withdraw it, and it's very safe. It's also insured by the FDIC. It's up to $250,000. And if your bank goes under or something happens to the money in the bank, your money is safe no matter what because it's insured by the federal government. Now, disadvantage of savings account, like I said, is that it has lower interest rates than CDs. It's not that much. It's like 0.01%. It's less than 1% typically. They also might have fees and minimum balance requirements. So I know that for some of the major banks like Wells Fargo and JP Morgan, they usually require you to have a certain amount of money in your savings account or you get charged like a fee like a couple dollars a month. And there's also transaction limits. So I know that for savings accounts, you can only withdraw money up to 6 times a month. And if you do more, some banks, they might charge you a fee for withdrawing more than 6 times a month. And then finally, we're going to talk about the US savings bonds. So you might have heard these. These are also called treasury bonds. And basically a bond is a glorified loan to like an organization or a corporation. So the advantages of US bonds are that they're very stable. They have typically low risk because they're backed by the US government. And what this means is that the US government, they're putting their like kind of like their credit on the line, if that makes sense. Another advantage of US savings bonds is that they pay interest, so they're kind of a fixed income. Now, disadvantages of savings bonds is that they're typically low reward compared to stocks or mutual funds because they're kind of like CDs and savings accounts. Since you're having stability, you're giving up kind of growth or reward potential. Like I said, there's also low interest rates these days. So I know that you might have heard in the news that the interest rates are coming down in the US, so that's not really good because then you're losing your money to inflation. And there's a risk of default. What that means is that the person that is borrowing money, so the one that's issuing the bond, they might not be able to pay you back the amount that they borrowed from you. But this is low risk. This is especially with US government because the US government hasn't really defaulted on their bond in quite a while. But this can also be a risk, but this is more of a risk with like corporations or other governments around the world. So keep that in mind. Now, I hope that you watched the Bill Ackman video and you sort of learned a little bit about investing. So I'm going to be having a stock market competition in our troop. So basically go to this link. It's tinyurl.com/998smg. So this is on MarketWatch. It's kind of like a financial news website, but they also have like a stock market game thing you can create. So please create a MarketWatch account. Make sure it's under your real name. Don't do like some fake or weird name. Make sure it's under your real name. And this started yesterday and it will be ending on March 8th, 2020. So the goal of this is that basically you kind of learn about stocks and you also get to kind of track the stocks. So basically I'm going to be allowing you to pick, I think you have up to like $100,000 to invest, and you can pick whatever companies or stocks you want to invest in. Don't worry about the 15 minutes of research part. I was going to do that when we had our merit badge class session today, but since we're doing this virtually, you don't have to worry about that. So the scout who has the most money at the end, so on March 8th, they will win a prize. So you want to do well in this. So basically, the reason why I was talking about stock tickers in the Bill Ackman video is that I want you kind of like a little bit learn about investing, since I was going to teach this anyway, about to do this virtually. So please watch that video. And if you're still kind of confused about the stock tickers, go back in the video and rewatch it again, and also watch the Bill Ackman video. So go to tinyurl.com/998smg, create a MarketWatch account. Make sure it's under your real name. You can also partner up with someone. If you do, please email me and tell me that you partner up with someone so that I know. And yeah, I wish you the best. So good luck. So anyway, that's the end of requirement number 5 in this video. Thank you for watching. I hope to see you guys soon.